Right now, there is a penalty running on a retirement account in America, maybe yours, maybe your spouse's, that maybe your sister's in Phoenix who called you last week about her IRA. 25% on every dollar that should have come out, and did not. Not because the person who owns that account did anything dishonest, not because they failed to file a form they knew about, not because they took money they were not supposed to take, because they did not know a rule existed, because the rule was not explained, because the people who should have explained it had no financial incentive to do so, and because the government, whose job it would be to notify you, decided that a clause buried in the Internal Revenue Code was sufficient notification. If you have a traditional IRA, a 401k from a job you had in 2009 or 2004 or earlier, a SEP IRA, a simple IRA, or any tax-deferred retirement account anywhere in the United States, this video is about a clock the government started on your money, a clock your bank knew about the day you opened the account, a clock your financial advisor knew about when he sold you the product, a clock the custodian of every retirement account you own has tracked every single year, and a clock almost nobody in that chain of people ever explained to you in plain English. My name is Kevin, and what I am about to walk you through in the next 30 minutes are 5 mechanical traps inside a single set of federal rules that are collecting 25% penalties right now from people who saved carefully for 40 years, people who did not take a dollar they were not supposed to take, people who simply did not know they were supposed to take any, people who are sitting in front of a television right now, in a house they paid off, with accounts they funded, quietly accumulating a liability they cannot see. Let me start at the beginning, because the name of this rule is boring, and the government likes it boring. Required Minimum Distribution, RMD, 4 letters that cover one of the most consequential retirement tax rules in the entire Internal Revenue Code. Here's the deal the government made with you. When you put money into a traditional IRA or a 401k, you did not pay income tax on that contribution in the year you made it. The money went in before the IRS touched it. Then it sat inside the account. It grew, it compounded, and for decades, the government did not touch it. That was not generosity, that was a deferred invoice. The government let your account grow for 30 or 40 years because eventually they wanted to collect taxes on a much larger number. Not just the money you put in, your contributions, plus 40 years of growth, all of it, taxed at ordinary income rates when it finally comes out. The mechanism for collecting that deferred tax is the required minimum distribution. Starting at age 73, under the current law, called Secure Act 2.0, the IRS requires you to withdraw a minimum amount from every traditional retirement account you own, every single calendar year. No extensions, no exceptions for being busy, no grace period for forgetting, no pause because the market is down. The calculation is specific. You take your account balance as of December 31st of the prior year. You divide it by a number from the IRS Uniform Lifetime Table. That number changes based on your age. At age 73, the divisor is 26.5. At age 74, it drops to 25.5. At age 75, it is 24.6. At age 80, it is 20.2. Every year you get older, the divisor shrinks, which means the required withdrawal grows larger. Even if your account balance stays exactly the same, and if the balance also keeps growing, which most accounts do in a decent market, the RMD grows faster. And if you do not take the full required amount by December 31st of the applicable year, the IRS imposes an excise tax on every dollar you were supposed to withdraw but did not. That tax is 25%, not 10%, not a polite reminder, 25%, on top of whatever ordinary income tax you would have owed on the distribution itself. The government did not run commercials about this. Your bank did not hang a sign above the teller window. The custodian of your account did not sit down at your kitchen table and walk you through what happens the year you turn 73. Because here's the thing about the financial services industry that nobody in a navy blazer ever says out loud. They make money when you put money in. They make money when you keep money in. They collect fees on balances under management. They do not make commissions on withdrawal mechanics. They do not get paid to explain the penalty structure for missing a distribution. So when that conversation should happen, it usually does not, and the government is content with that, because the penalty collected from missed RMDs runs into the billions. From people who saved responsibly, from people who followed every rule they knew about, from people who simply were never told about the one that mattered most in the final chapter. What I am about to do is exactly what they did not. 5 real mechanical situations where ordinary Americans walk straight into the 25% penalty without taking a single step they intended to be wrong, and the moves that stop each one cold. Let us start with the first. Let me introduce you to Frank. Frank is 73 years old. He lives in Knoxville, Tennessee. He worked for a regional electric utility for 34 years. He started in the maintenance yard at 21. He retired as a supervisor. He has a traditional IRA worth $420,000. He also has a small pension from the utility. But the IRA is where the real retirement savings are. The 40 years of deferred growth. The account he watched carefully through every market cycle. Frank is a careful man. He tracked his contributions every year. He did not touch the account when the market dropped in 2022. He did exactly what everyone said to do. He left it alone and let it grow. So when his RMD year arrived, Frank called his financial advisor. He wanted to handle this correctly, and his advisor said something that sounded perfectly reasonable. He said, "Frank, you do not have to take your first required minimum distribution right now. The law allows you to delay your very first RMD until April 1st of the following year. We can wait." Frank thought that was smart. Delay means one more year of growth before the government gets involved. One more year of compounding. What is not to like about that? Here is what his advisor did not say. When you delay the first RMD to April 1st of the following year, you still owe the second RMD by December 31st of that same year. 2 required minimum distributions, both hitting in the same 12 months, both counted as taxable income on the same tax return, on the same Form 1040, on the same provisional income calculation. Frank's IRA had $420,000 at the end of 2024. At age 73, his divisor is 26.5. His 2024 RMD was $15,849. He delays it to April 1st of 2025. But his 2025 RMD is still due by December 31st of 2025. His account grew to $438,000 by the end of 2024 because markets moved. At age 74, his divisor drops to 25.5. His 2025 RMD is $17,176. So in calendar year 2025, Frank must take $15,849 by April 1st and $17,176 by December 31st. That is $33,025 of taxable income inside 12 months. Frank's normal income is $24,000 a year from Social Security and the small pension. That double RMD year pushes his total household income above $57,000. Here is what that triggers. Up to 85% of his Social Security becomes taxable under federal law. It was already partially taxable at his prior income level. Now almost all of it is. And the income spike changes his provisional income calculation in a way that carries forward. The Social Security Administration does not recalculate your Medicare premium in real time. They use your income from 2 years prior. So the double RMD year in 2025 affects Frank's Medicare premium in 2027. That is the IRMAA surcharge, the income-related monthly adjustment amount. The Medicare income penalty that most retirees do not know exists until they see it on their Medicare notice. Tax advisors who work with retirees have documented this pattern repeatedly. The double RMD year from delaying the first distribution costs clients between $10,000 and $15,000 in combined additional taxes and Medicare costs, compared to simply taking the first RMD on the normal December 31st schedule. One sentence from an advisor, one delay that sounded like planning, $10,000 to $15,000. That is the April delay trap. It is the first way the penalty finds ordinary retirement savers, and it is the one that surprises people most. Because the advice came from someone they trusted, because the delay is technically legal, because every part of the conversation felt responsible. The April 1st option exists in the law for a narrow purpose. Someone who turns 73 in late December, someone who needs 3 extra months to arrange the logistics of their first distribution. It was not designed to be a planning strategy. It became one because advisors started mentioning the option, without finishing the sentence that explained what it costs. Now, I want to pause here. Because the information I just walked you through about Frank, the specific mechanical understanding that protects you from a tax bill that should not exist, that is exactly the kind of thing that lives in a document I put together called The Quiet Rules. It is $27 at kevinexplains.shop. There is a 7-day money-back guarantee. No forms, no hoops, no explanation required. If you read it and do not find information that is worth 10 times what you paid, email me. You get every dollar back. KevinExplains.shop. Before we move on, if you are not subscribed to this channel, hit that button right now. This video is one of a series. The next one covers what happens when the IRS discovers missed RMDs not in the year they were missed, but 3, 4, 5 years later. When they are calculating cumulative penalties across multiple accounts going back to the year you turned 73. That math in that conversation is not something you want to encounter unprepared. Subscribe, flip the bell, be inside before that one drops. Now, the second trap in this set catches people who were genuinely responsible, people who saved, people who kept track, people who did exactly what the industry told them to do for 30 years. Let me introduce you to Ruth. Ruth worked as a hospital administrator in Columbus, Ohio. 31 years across 4 employers. Every employer offered a retirement plan. Ruth participated in every one. When she retired at 68, she had a traditional IRA she had funded during job transitions. She rolled money into it every time she left a job. But not every time. She had 3 old 401k accounts from employers she had not worked for in over a decade. 2 of them from jobs she held in her 40s. 1 from a company that was acquired and renamed twice since she left. Ruth was organized. She had a folder. She knew the balances. When she turned 73 and RMDs began, she sat down at the kitchen table with that folder. She added up every balance. She ran the calculation. And she took 1 withdrawal from her IRA to cover the total amount. She thought she had done it correctly. She had not. Here is the rule that was never explained to her. Traditional IRAs have an aggregation rule. You calculate the required minimum distribution for each IRA separately. Then you can add those numbers together and take the full total from any one IRA, or split it across multiple IRAs in whatever proportion you choose. The flexibility is real. 3 IRAs, 1 withdrawal from the biggest one, everything satisfied. 401k plans do not have that flexibility. Each 401k is a separate and independent obligation. Each plan requires its own RMD, taken from that specific plan. You cannot satisfy a 401k RMD by taking extra money from your IRA. You cannot pool the 401k obligation with the IRA total. The IRS is explicit. Employer-sponsored defined contribution plans stand alone. Cross-account substitution is not permitted. Ruth's 3 old 401k accounts had a combined balance of $190,000. At age 73, with a divisor of 26.5, her combined obligation from those 3 plans was roughly $7,169. She took 0 from them. She took everything from her IRA. The IRA RMD was fully satisfied. The 3 401k RMDs were not. 25% excise tax on $7,169. That is roughly $1,792 in penalties. On accounts she owned. On money she had been careful with for 30 years. On a rule that distinguished IRAs from 401k plans in a way that nobody in her chain of advisors ever spelled out in plain English. And here is where Ruth's situation compounds into something more serious. She has been doing this the same way for 3 years, because no one corrected her in year 1. The IRS does not send a real-time notification when a 401k RMD is missed. The penalty accrues silently. The account custodian reports distribution data to the IRS during routine tax year reporting. When the IRS cross-references that data against the RMD obligation, they are not just looking at the current year. They reconstruct every year back to the date the obligation started. 3 years of missed 401k RMDs across 3 separate accounts. 3 rounds of 25% penalties. On accounts that were growing the whole time. On accounts that felt fine every time Ruth opened the quarterly statement, because the statement showed a balance, not a penalty. Here is the fix. If you have old 401k accounts from previous employers, you can roll them into your traditional IRA. The mechanics are simpler than most people assume. You contact the 401k custodian. You tell them you want to initiate a direct rollover to your IRA. The custodian transfers the funds directly to your IRA custodian, institution to institution. No check made out to you, no 20% withholding, no taxable event. Once the old 401k funds are inside the IRA, the aggregation rule covers everything. 1 calculation, 1 withdrawal, 1 December 31st deadline. All obligations satisfied. The note about timing. If you are in an active RMD year, there is a sequencing requirement. You must take the current year's RMD from the 401k before rolling the remainder. So if you are 73 or older and have old 401k accounts that have not been rolled, The conversation with a tax professional or fee-only advisor needs to happen before December 31st, not after. Now let me tell you about the third trap, because this one is different from everything I have described so far. This one is not about what you did. It is about what your children are sitting on right now, what they inherited, what they do not know the rules on, and what the IRS started enforcing last year after 4 years of telling everyone it was fine. In December of 2019, Congress passed the Secure Act. Among other provisions, it eliminated something called the Stretch IRA. Under the old rules, when a non-spouse inherited a traditional IRA, a son, daughter, grandchild, sibling, or friend named on the account, they could stretch distributions over their own life expectancy. A 55-year-old inheriting from a parent could take small distributions for 30-plus years. Maximum tax-deferred growth, minimal annual tax impact. The Secure Act ended that, under the new law. Most non-spouse beneficiaries who inherit an IRA after January 1st of 2020 must empty the entire account within 10 years of the original owner's death. Full depletion. By December 31st of year 10. Most people who inherited IRAs after 2019 know about the 10-year deadline. What most of them did not know, until the IRS published final regulations in July of 2024, is that for a significant portion of those beneficiaries, the 10-year window is not a passive waiting period. They owe an annual required minimum distribution in each of years 1 through 9, and then the full remaining balance must be gone by year 10. Here is specifically when the annual requirement applies. If the person you inherited from had already reached their required beginning date, meaning they had already started taking their own RMDs before they passed, then you as the beneficiary cannot simply let the account grow for 9 years and distribute everything in year 10. The distributions that were already in motion do not stop. You owe an RMD from the inherited account every single year for 9 years. Then the account is empty in year 10. Now here is the part that explains why so many families are completely unprepared. The IRS waived the penalty for missing those annual RMDs inside the 10-year window. From 2021 all the way through 2024, 4 consecutive years of penalty relief. The notices came out in 2022, 2023, and 2024. Each time the IRS said the same thing. We are not penalizing people for missing the annual RMDs this year while we finalize the regulations. 4 years. People inherited accounts. They let them grow. They assumed the 10-year rule meant 10 years to figure it out. The IRS kept not penalizing anyone. The behavior felt fine. The account balance went up. Nobody called. That waiver ended on December 31st of 2024. Starting in the 2025 tax year, and running through right now in 2026, those annual RMDs are fully enforced. 25% excise tax on every dollar of annual RMD that should have been taken and was not. The waiver is over, the enforcement is live, and the families affected are still in the dark. Think about who this affects right now. If you own a traditional IRA, and you have adult children or grandchildren named as beneficiaries, the moment you are gone, a very specific 10-year clock starts on that account. And if you were already past your required beginning date, your children owe annual RMDs starting in the year after your death. They will receive a letter from the custodian. The letter will mention the 10-year rule. It will not walk them through the annual RMD calculation inside that window. It will not explain that the 4-year penalty waiver just ended. It will not reference the July 2024 final regulations that created the annual requirement. It will be a form letter with a deadline. And in the worst cases, your children will sit on a $200,000 inherited IRA for 3 years. Assuming they have time, because the account is growing, because nobody from the IRS is calling, because they inherited an account, not an instruction manual, and the penalty will be stacking every December 31st. The conversation to have with your children now is not about money, it is about rules, not what is in the account. What are the distribution requirements on the account when they receive it? What is the annual obligation? What is the filing requirement? Because the information exists. It is just never delivered to the people who need it most, at the moment they need it most. At kevinexplains.shop, the quiet rules is $27, and I want to say something about it that I do not usually say. It is not just for you. It is the kind of document you hand to the person who will inherit your accounts, so that when the letter from the custodian arrives, and the letter does not explain the annual RMD inside the 10-year window, they already know. 7 days to read it. Full refund if it does not help. kevinexplains.shop. If you have been watching this channel for more than one video, You already know I do not put out content designed to feel like content. Subscribe, tap the bell. Because the next video in this series covers what happens specifically with inherited Roth IRAs, which have their own set of rules that most families get completely wrong on the tax-free distribution timeline. Subscribe, flip the bell, be inside before it drops. Now, the fourth trap. This one catches people who think they are safe, people who are still working, people who heard the words "still working" exception and assumed they applied to everything. The law does include a real exception for working Americans. If you are still employed, and your current employer offers a 401k or a similar defined contribution plan, and you participate in that plan, you can delay taking RMDs from that specific plan until the year you actually retire, not age 73, the year you stop working. The exception is real. The key word is current employer, that specific plan only. It does not protect your traditional IRA. It does not protect 401k accounts from jobs you left 5 or 10 years ago. It does not protect SEP IRAs. It does not protect simple IRAs. It does not protect 403b accounts from a previous employer. It does not protect anything, except the plan sponsored by the organization you are actively employed by right now. Let me introduce you to Thomas. Thomas is 75 years old. He works 3 days a week at a landscape architecture firm in Raleigh, North Carolina. He loves the work. He is not ready to stop. His current employer has a 401k, and Thomas still contributes to it. Thomas also has a traditional IRA he built from 2003 through 2018, and an old 401k from a construction company he left in 2015. When he turned 73, Thomas asked his current employer's HR department whether he needed to take RMDs. HR said the still working exception applies. HR was telling him the truth. About the current employer's 401k, Thomas heard it as a general clearance for all of his accounts. He stopped thinking about the question. He went back to work. He did not take a distribution from his IRA. He did not take a distribution from the 2015 401k. He has been 73, 74, and is now 75. 3 full years. 3 years of missed annual RMDs from 2 separate accounts. Then his IRA had $310,000 when he turned 73. His divisor at 73 was 26.5. His first-year RMD from the IRA alone was $11,698. His second-year RMD was calculated on a larger balance. His third-year RMD higher still. 3 years of missed IRA distributions. 3 years of missed old 401k distributions. The 25% excise tax applied to every year of every missed amount could easily run between $8,000 and $12,000 in excise taxes alone, before the ordinary income tax on the distributions themselves. Thomas asked a question. He received an accurate but incomplete answer, and the gap between what HR said and what the rule actually covers is costing him thousands of dollars. The still working exception protects one plan, current employer only. Everything else is on the same clock as every other person in America. Who has reached age 73 with money in a tax-deferred account? And here is the danger of old 401k accounts specifically. They sit. They grow. Nobody at the former employer calls you after you leave. Nobody sends an annual reminder that an RMD obligation has begun. They send quarterly statements showing a balance, and a growing balance feels like success. After age 73, a growing balance in an old 401k you have not touched is a growing penalty, waiting to be discovered. The consolidation strategy I described for Ruth applies equally to Thomas. Roll the old 401k to the IRA. One direct transfer, no taxable event. IRA aggregation covers everything in the same calculation. One December 31st deadline, one withdrawal, done. Now, I want to spend the final section of this video on the part most people do not hear. Not another trap, the exit. Because I have walked you through how the penalty fines people for 30 minutes, and I will not leave you inside it without a door. Mira, here is the first exit. The IRS built a correction window into the law, 2 years. If you discover a missed RMD, whether from last year or 3 years ago, take the missed distribution now. File IRS Form 5329. Attach a letter explaining the circumstances. Mara, the penalty drops from 25% to 10%. Mara on $10,000 of missed distributions. That is the difference between $2,500 in penalties and $1,000 in penalties. It is not nothing. And it is available to anyone who acts within 2 years of the missed year. MERA, and in cases where the IRS classifies the error as reasonable, a penalty that can be waived entirely. The letter attached to Form 5329 is your opportunity to explain. I did not know this account had a separate RMD obligation. I was told the still working exception applied to all my accounts. I inherited this account and was not informed of the annual distribution requirement. MERA. The IRS has the authority to waive the excise tax under those circumstances. They do not always use it, but they have it, and they exercise it. For people who find the exit before the IRS finds them. The people who pay the full 25% are almost always the ones who did not know the correction window existed, who received the IRS notice, who panicked, who sent a check for whatever the letter said, without knowing that self-correction was an option, without knowing a letter asking for waiver was an option, without knowing Form 5329 was the document that opened the door. The second exit is more powerful, and it is the one the industry has the least incentive to explain, because no financial product gets sold when you use it. No one earns a fee in the middle. It is called a Qualified Charitable Distribution, a QCD. Starting at age 70 and a half, you can transfer money directly from your IRA to a qualifying charity, not from your bank account. Not to yourself and then to the charity, directly from the IRA custodian to the charitable organization. The IRS limit in 2026 is $108,000 per person per year. Here is the mechanism. That direct transfer counts toward your required minimum distribution for the year, and it is completely excluded from your adjusted gross income. The money satisfies your RMD, but it never appears as taxable income on your return, which means it does not push you into a higher tax bracket. It does not make more of your Social Security taxable. It does not trigger the IRMAA Medicare surcharge. It does not appear in the provisional income calculation that determines how much of your Social Security is taxable. A QCD is not a charitable deduction. It is better than a deduction. When you take a deduction, the income appears on your return first, then the deduction reduces it after the fact. But the Social Security calculation, the IRMAA threshold, the bracket calculations, all of them see the income before the deduction removes it. With a QCD, the income never appears. There is no income for any of those calculations to see. For seniors who give to their church, their hospital foundation, their local food bank, their alma mater, who are currently pulling money from an IRA, paying income tax on it, and then donating the after-tax amount, the QCD eliminates the tax entirely. The full pre-tax dollar goes directly from your IRA to the organization you care about. Your RMD is satisfied. Your taxable income is not increased. The mechanics are simple. You call your IRA custodian. You tell them you want to make a qualified charitable distribution. You provide the name and mailing address of the qualifying 501c3 organization. The custodian sends the check directly to the charity. You receive written confirmation from the custodian and from the charity. Those documents are your tax records. You report the QCD on your tax return. You report 0 of it as income. One note on account type. QCDs only work from IRAs, not from 401k accounts. If you have charitable intent and money currently sitting in an old 401k, roll the 401k to an IRA first. Once the money is in the IRA, the QCD is available. The direct transfer goes from the IRA to the charity. Your RMD obligation is satisfied, and none of it becomes income. The QCD is the structure the IRS built into the federal tax code that no financial product salesperson has any commission incentive to mention. Because when the money goes directly from your IRA to the charity, nobody in the middle earns a basis point. So nobody in the middle brings it up. This is what I mean when I say these are the quiet rules, not secrets, not classified, not hidden behind a wall of professional fees. They are in the Internal Revenue Code. They are in IRS Publication 590-B. They are on irs.gov in plain language. They are quiet because the people who benefit most from knowing them are watching television in the living room, and the people who should be explaining them are paid on product sales, not on the distribution rules that let you keep what is already yours. Let me pull this together, because I want to leave you with the complete picture. 5 traps. 5 real mechanical situations where ordinary Americans walk into the 25% penalty without a single dishonest step. The first, the April delay trap. A technically legal option to push your first RMD to April 1st of the following year. That forces 2 required distributions into the same calendar year, spikes your income on one tax return, makes more of your Social Security taxable, and can cost $10,000 to $15,000 in extra taxes and Medicare surcharges. that a simple December 31st distribution in your first RMD year would have avoided entirely. The second, the 401k aggregation mistake, the one where you take all your distributions from your IRA thinking it covers everything, while old 401k accounts from previous employers sit untouched, each one accumulating a separate 25% penalty on obligations you did not know those specific plans carried independently from your IRA. The third, the inherited IRA time bomb, the one your adult children may be sitting on right now. If they inherited an IRA from someone who had already started their own RMDs after the Secure Act of 2019, and after the 4-year penalty waiver that ended December 31st of 2024, left an entire generation of beneficiaries thinking they had time they no longer have. The fourth, the still working exception myth, the one where HR answered your question accurately but incompletely, and the gap between your current employer's 401k being protected and your IRA and every old plan from every previous employer still running on the age 73 clock turned into multiple years of missed distributions nobody was tracking. And finally, the exits, the correction window the IRS built into the law that almost no one knows exists. 2 years, Form 5329, a letter. A penalty that drops from 25% to 10%, or in genuine reasonable error cases, nothing at all. And the QCD, the direct charitable transfer that satisfies your RMD and never touches your taxable income, that the custodian never proactively explained, that lets the full pre-tax dollar go to the cause you care about, while your Medicare premium stays where it should be, while your Social Security stays where it should be, while your tax bracket stays where it should be. This is the system. This is how it was engineered, not by malice, by incentive. Nobody in the chain gets paid to explain the exit, so the exit stays quiet, and the penalty collects, year after year, from people who saved everything they were supposed to save. The quiet rules is $27. It is at kevinexplains.shop. I do not know the specific accounts you have. I do not know how many employers you worked for or how many old 401k plans are sitting in folders you have not opened in years. I do not know whether your children know about the annual RMD obligation inside the 10-year window, or whether they assume they have a decade to figure it out. But if you have traditional IRA accounts and you are over 70, or if your children are named as beneficiaries on any account you own, or if you have old 401k plans from previous employers that have not been consolidated, or if you are still working and assumed the still working exception covered your IRAs and your old plans too, this document was written for exactly where you are standing right now, kevinexplains.shop. And if you want me to look at your specific situation personally, reach me at kevinexplainsofficial@gmail.com. Small fee. Most people save 10 times what they pay. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.